Hey, welcome back. Next, we're going to start off with chapter 3. The first video, I'm going to approach a little bit different. So this chapter focus is mainly on the different accounts within the elements of the financial statements or the financial records. And remember, the elements are the main categories, which are assets, liabilities, equity, revenue, and expenses. So in chapter 2, each transaction, we talked about it in the context of these 5 elements. However, in this chapter, we're going to do transactions again, but we're going to actually put them into the actual accounts that they belong in within these 5 elements. And this is what accounting is all about. So I took the effort to compile a list of not all of them, some of the main accounts that will be used throughout this course. Just keep in mind that these counts differ from question to question, from company to company in the real life world as well. So once again, I don't want you to memorize these accounts. I want you to understand them logically. It'll make your life 10 times easier when you're doing these transactions and you're trying to figure out which accounts to go under. Because if you think about it logically, it's much more easier to think about these accounts. So let's quickly have a quick discussion about the different accounts. And I'll show you and I'll explain to you why they fit within that element. Remember, an asset is a future benefit. Cash is obviously a future benefit. You can use cash to buy things like inventory. Accounts receivable is a future benefit because someone owes you cash in the future. Supplies and office supplies are essentially the same thing. So we can use these interchangeably. So supplies is things like paper, pencil, pen, stuff like that. These obviously differ from inventory because inventory is a product that you're selling. So don't get these two confused. Supplies and inventory are two different things. Supplies is once again paper, pen, stuff like that. It's things that you need to run your business. Whereas inventory is what you're selling, like water bottles, calculators, etc., etc. Prepaid rent and prepaid insurance is when you pay for rent or insurance in advance. So now the company that you pay for in advance owes you the service now. So once again, that's a future benefit. Land, building, and equipment are all future benefits because your building is situated on the land and the equipment is within the building and it helps you produce your inventory. Future benefit. Patents, business license, and website design are all future benefits because it provides you with some sort of benefit in the future, right? And remember, these are intangible assets. They don't have physical substance. However, they still provide you with some sort of benefit. Website design, like, for example, a company website can bring in a lot of business. The fact that you have a business license gives you the right to operate. And patents is essentially a document that you received or a property that you have, whereas others cannot use or make that one invention, for example. So that's a future benefit. Now let's talk about liability. Remember, liability is a future obligation. Accounts payable is a future obligation because you owe your suppliers money in the future. Salaries payable, you owe your employees money in the future. Interest payable, you owe the banks or your creditors interest on the loans that you've taken out. Income tax payable is when you owe the CRA money in the future for taxes. Unearned revenues is, for example, let's just say that we manufacture water bottles and we sell it for a markup. So simply put, someone comes to us today and they give us $1,000 and they want us to deliver water bottles to their child's wedding in a month from now. So we got the cash today, but we haven't earned that revenue. So unearned revenue is a liability because now we have the future obligation to deliver those water bottles in the future. Another term that's used for unearned revenues within this textbook is fees received in advance. It means the exact same thing. We haven't earned that revenue yet. But once we earn that revenue, then that quickly becomes sales or service revenue, correct? But for now, since it's unearned, is going to be a liability. Mortgage payable, you owe the bank money for your house. Bank loan payable, you took out a bank loan, you owe the bank's money. Notes, bonds, loan payable, they all fall under the same category. It's a liability. So once again, we'll talk about these more in detail as we go throughout this chapter and the future chapters. Under equity, we have owner's capital, which is owner investments. Then we have retained earnings. Remember, retained earnings is a product of the beginning retained earnings balance plus profits minus dividends. Remember, revenues is income earned. Very key. Sales revenue, we sell a product. Service revenue, we sell a service. Let's just say, for example, my brother's a barber, so that's service revenue for him. Rent revenue is, let's just say, for example, in the building that we have, we rent out a room, so we're earning revenue on that. Interest revenue is, let's just say, for example, that we've given our friend a loan or a different company a loan, and then we earn interest on that. Installation revenue, this can relate to a company that installs stuff. So these accounts can change depending on the question and the company, correct? So keep that in mind. The common type of expenses are cost of goods sold. Cost of goods sold is a direct expense related to inventory when we sell it. Remember, an expense is a cost incurred, used up, or consumed in order to help us earn revenues. Rent expense is we rent out a room where we produce our products. Supplies expense is related directly to supplies. This is when we use up the supplies. So we consume that asset. Income tax expense, insurance expense, depreciation expense, travel and entertainment expense, salaries expense, and wages expense. The difference between salaries and wages is that salaries is paid on a yearly basis. Not paid on a yearly basis, but you get paid $60,000 a year. So if you work overtime or less hours, you still get paid $60,000. Whereas wages, you get paid hourly. That's the difference between salaries and wages. Telephone expense, utilities expense, advertising expense, and office supplies expense. Essentially, all of these are expenses that go directly onto the income statement. And there's a cost of doing business.